All right. I don't know if you guys can hear me. I feel like I've got sound problems. John, are you out there? Can you tell me if you can hear me? I am not having good luck here. Testing, testing. Oh, you can hear me, huh? Well, something's wrong with my system because I can't hear myself. I can't hear anything that's going on. Let's see. You hear me. I can hear you. All right. I guess it doesn't matter that my audio's not working. It only matters that yours is. Okay. We'll have to work on that another time. All right. Well, here we are. Let's get rocking and rolling. All right. My name is Lan Turner, and this is the lab class for our last night university class. All right. So last night we met down at Utah Tech University and had a great class. The class was full, almost no seats left. So it's wonderful to see everybody there and everybody getting excited about coming and trading in the stock market and learning how to do this. Now we're getting everybody started. We talked a lot about exchanges, what exchanges are, talked about what brokerage firms are, and how to get started, getting your account set up, getting money into the markets, how to do that. And now we're going to talk about where to put your money. All right. We're going to talk about the charting applications, because when it comes down to trading and the stock market, once you get kind of the peripherals out of the way, right? The things that just the housekeeping stuff, right? Understanding the structure of the financial market, where your money's going, why it's sitting there, why it's sitting here, who's touching it, who's got control of it, and then who makes all the decisions, right? And then after that, it just comes down to the simple process of finding good stocks to trade, looking for the right opportunities for entry, and then making the trade, putting your money into the market. So there's a number of different ways of making money in the financial markets. I oftentimes like to call this, like call the financial markets a, I call it a financial sandbox. And after class last night, I mentioned this to a couple of students, but it's a financial sandbox where you can basically create any kind of business model in the stock market that you want. Now, most people think of the very simplest style of trading. And the simplest and most common and most popular is to buy something and hold on to it for a long period of time. All right. Lots of people do that. And that's how a lot of trading gets done. It's just called growth. All right. Growth trading. So when you do growth trading, it means that you buy something and you hope that it appreciates in value. Just like a house, if you're going to be in real estate, you can mimic real estate in the financial markets. How? Well, if you're going to buy a house and you're going to hold on to it for 20 years and then hope that it appreciates in value, and then you sell it at the end of the 20 years and you got money, then that's how you make money, right? Appreciation of value over time. Well, stocks are supposed to do the same thing. If it's a good company, they will grow over time. If it's a bad company, they will shrink over time. Same with real estate. If you buy into a bad real estate market and the prices go down, well, you lose money on your house. A lot of people think that buying a house is an investment. It can be, but mostly it's not. I mean, it's your place, it's where you're going to live. So you're not going to realize a profit, you have to sell something that you bought, and you have to sell it for more than you bought it for. So your house, although you're going to buy a house and then you wait for it to appreciate in value, you might sell it, but you're not going to really sell it, then go live on the street, hopefully. All right. You're going to sell it and buy another house. I mean, your house is really something that is not an investment. You can use it as a leveraged item because it has value, but you're not going to really buy it and sell it and realize the profit from it. And of course, I know that there are some strategies that you can do that. And that's a little bit beyond the scope of this conversation. But the point that I'm trying to make is relating the financial markets, the stock market, to the real estate industry, because a lot of people understand real estate, and I want you to think about them kind of the same way. You're going to buy something, you're going to hold on to it for the asset to appreciate over time, and then you're going to sell it at some point and realize the profits. All right. You're not going to really do that with your house, because you're not going to sell it, because then you're homeless. So you're just going to go buy another house. And usually you buy a more expensive house because you don't want to get 1031, and it's all a big tax game. And right. But of course you have to pay taxes in the stock market too. When you make money, it really sucks, because they're going to the government wants some of it. So we are in business. Anytime you go into business and try to make money, you're going to go into business with the federal government and the state government, right? It's a partnership. You're going to go into business, you're going to start making money. And that's what we want to look at our financial trading for. We want to look at it as if you are in business. So you're starting a little business here, and we're going to go in and we're going to try and make money. And when you make money, you have to share that with the government. Now, there are some ways that you can postpone your taxes. All right. So like 401ks or IRAs, you can do stuff like that, and that will postpone your taxes off into the future, and your tax and your accounts can grow tax-free, which means that you got all the tax money that is growing too. All right, so it gets to grow. You don't have to pay it out first, and then it grows. Of course, there's some you can pay first. You pay the taxes first, and then you get to keep all the growth. So there's different ways you can play it: IRAs, Roth IRAs, 401ks. There's all kinds of fun little things like that, and we can talk about those later times, a little bit beyond the scope of this class. But there are things you can do to kind of delay or put off paying taxes. All right, you never get away from paying taxes. You can't pay taxes. That's just the way it is. There's no free lunch. All right, but there are ways to use the tax money to your advantage, and then the government gives you some tax advantage things that we can do, which allow us to go do tax loss harvesting and that kind of stuff. All right, but that again is a little bit beyond the scope of this class. I just want to make mention of it so that you understand and realize that taxes are a real process that we have to deal with in the financial markets, because if we make money, they want some of it. Okay, they want to be able to go buy their bombs and go buy their whatever else it is they buy. We don't know. They're closed right now, right? And I'm certain that there are people who work for the government who are kind of a little stressed right now. And I apologize I'm not making fun of that. You guys, I hope that you get your jobs back and get back to work soon. But nonetheless, the government does want to take your money when you make some, and they have things they want to do with it too. Make roads, okay? Let's fire, police. They do good things with their tax money. So we're in partnership with them, so they'll provide those services to us, and that's where they get the money to do it. So when you make money, you got to pay the government. Okay, so we want to reduce the amount of money we have to pay the government very best we can, but we don't ever get away with not paying money, paying taxes. All right, you can postpone it and use that postponed taxes to your advantage to make more money, and that's the whole idea. That's the concept I want to get across. All right, so now I want to come in and I want to talk to you about finding the stocks that you want to trade. Now, we talked a little bit last night about getting your account set up so you could trade stocks, but now we want to find the ones that we want to trade. And I talked a little bit about some of the most popular, some of the most common stocks, and one of those is called the Magnificent Seven. Let's make this a little bigger so you can see it. And the Magnificent Seven is they are the most popular, most common stocks in the entire market. And so we're going to start by looking there. Now, we're going to go from individual stocks to what we call ETFs, exchange traded funds, which are baskets of stocks. We talked a little bit about that. So I'm going to show you how that works. Okay. So whenever we're going to look for a stock, all right, now I have a list of them already listed here. But what you do is you come into your trading platform, whether it's on your phone or whether it's on the internet or whether it's a live trading platform like this one that I use, which is called Track and Trade. All right. So here, in fact, I'll give you a little, just real quick here, show you the software I'm using so you can go get it.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, John, did you hear that? That is that's a little ad that pops up that I can just show you the software that I'm using so you can run and grab it. Now, I don't know if you could hear it. I couldn't hear it. So you say you can hear me. I don't know if you could hear that little ad that just popped up to tell you where to go to get the software that I'm using. So that's the software I'm using. It's Track and Trade. You can go get your version over there. You can go get it right now if you want and do it while you're watching this, but if you can do two things at once. But if not, and it's a desktop version, it's not going to run on it's a professional trading platform. There's a difference between charting application. Okay, so it worked for you. All right, so I guess I'm the only one that can't hear anything. Okay, so you go get your software. It's going to run on your desktop or on your laptop. It's not going to this live trading platform doesn't run on your little iPhone. So you can use a little iPhone version, or you can use the professional trading platform. I'd recommend you get serious about it. You want to use the professional trading platform, not the little iPhone app. And we talked about that last night. It's free. But this one costs a little bit of money, but it's worth it because it's a professional platform, and you do everything right through here. It connects to your account, and you trade through it. All your money's in here. All of your accounting's in here. Everything's right here in one location. So this becomes the stock market for you. So this is your window into the stock market. All of your accounting, everything's right here. And that's why it's so much easier, so much faster, so much more wonderful. And you place your orders right here, right on the screen, right through the chart, right through everything. It's all done right here in one spot. Okay. So that's the application I like to use, and you're free to use whatever you want. I'm not telling you what to do. I'm just telling you what I do. All right. So this is the Track and Trade software, and we need to now find charts to trade or markets to trade. Now, Track and Trade is a trading platform. It doesn't find charts for you. It's not a scanner. It doesn't go out and say, hey, this is something you should trade. So there are those types of services that you can use, and there are some that I like, and here's one. I'll pull it up and show you. This is called Trade Miner, just to give you a little idea where you're going to find some stocks to trade. All right. Now, there's the most common stocks. How come I can't get that? There we go. Okay, so this is called Trade Miner. It's another software tool. It's a scanner. And this is based on the seasonal nature of markets. Markets have a tendency to do the same thing year after year after year. All right. They're very cyclical in that regard. And the reason is because think about a stock, for example. You have taxes at the same time every year. You have board meetings at the same time every year. You have earnings at the same time every year. You have all the same kind of things that happen year after year after year. You have Christmas same time every year. You have holidays at the same time after year. Over and over and over. It's just a repeating cycle year after year. Events that occur at the same time every year that affect the stock market. So we can find that. That's what this little tool right here does. And it comes in, you say, search for the month and the month of, and we're just going to do month of, and this is October. So we'll go October, and we're going to find trends that have won at least 80% of the time. We only want bullish ones. We don't care about ones that are falling. Although it's not bad to look at the bearish ones too, the ones that fall during a certain time of the year, because you might not want to be in those stocks. All right. So it'll tell you which ones are probably going to go down. So then you say list trends that last at least 10 trading days, but no more than 25 trading days. So this is for basically a shorter term trading window, a 1 month period. All right. So we're going to find at least 10 years of history. So it has to be at least 10 years long where it's done these seasonal trends, but it can be longer, just a minimum of 10 years. All right. So we're going to search that, and I'm going to show you. It's just a fun little tool, and this isn't going to be a big, long class about Trade Miner. I just want to show you that there are scanners out there on the market that can help you identify stocks that are good to buy during a specific time. Now, there's different types of trading, and we talked a little bit about that last night. What type of trader are you? Are you short-term trader, long-term trader, mid-term trader? Are you an investor? Are you, going to be for growth? Or are you going to go for yield? What type of trading are you going to do? So these would be considered stocks that you might buy for a shorter term trade. You're going to buy low, sell high, and make some money over a period of time. So for example, this one comes up here, and it's got a score of 5.0. And if we slide down through the scores, you can see that it go down, the score goes down, and then eventually it goes yellow, and then eventually it goes red. Now, red doesn't mean it's bad. It's just not as good as the yellow and green ones. They still meet this criteria above. It's just that these listed in the 5s are the best. All right. So you say, we can come down here, find one you recognize. There's Schwab, there's Parker Hannifin, there's Rockwell, there's Bank of America. You recognize Bank of America. It's got a 5. Bank of America is between October 30th and December 1st, during that time frame, 85% of the time, Bank of America, over the last 13 years, 33 calendar days, has averaged a 9% increase in value. All right. Does it mean it's going to do it again this year? No, these are averages. But it's saying between October 30th and December 1st, over the last 13 years, 85% of the time, this thing's made about 9% return on your money. It's better than you can get at Cash Valley Bank. All right. And it's got a pretty good track record. Doesn't mean it's going to happen this year, but it's something that you can go look at. All right. Let's just look at the very first one, CBOE, Chicago Board of Options Exchange. All right. So this is between October 24th and November 28th, 100% of the time over the last 14 years, this thing's averaged 7% return on your money in a 36-day period. Now, a lot of people go down to Cash Valley Bank and they'll give them their money and they'll wait for an entire year to get 4.5%, right? This opportunity, 100% of the time, now just because it did it 100% of the time over the past 14 years doesn't mean it's going to do it again. All right. It's just got a pretty good track record. So over the last, 100% of the time between October 24th and November 28th, over the past 14 years, this thing's returned 7% in 36 days over that time frame. That's pretty good. Here's another 100%er right here. October's a good month. Hilton Worldwide Holdings, between October 27th and November 12th, 100% of the time over the last 11 years, this thing's returned 5%. This one here, Citizen Financial, October 20th, between October 20th and November 14th, 100% of the time over the last 10 years, this thing's returned 11%. So if you're looking for stocks that you want to buy and sell, this isn't the buy and hold. This isn't like I'm going to buy it today and sell it in 20 years. This is actual trading. So you make money. This is buy it on October 20th and sell it on November 14th. They're somewhere close to those dates, right? And 100% of the time over the last 10 or 14 years, that thing's returned 7% return. So you might want to go look at some of these. This is just one scanner and one way of doing it. There's lots of scanners that help you. Oh my goodness. Hold on a second. I'm losing my voice. All right. So there's lots of scanners that you can use. This is just one of them that I like. So we'll go ahead and hide. This is called Trade Miner. So just go to trademiner.com if you want to pick up the scanner and you can have that scanner. So that's a nice way to do it. Now here's another scanner I like. And we talked about this little company last night. This is called FinViz. And FinViz has a little charting application. And if you come to their homepage, they got a couple of little ticker windows that tells you what's hot and what's not today. These don't, as we talked last night, these aren't really that helpful in my opinion because they include too many stocks. And usually what shows up on the high return stocks, the big gainers and the big losers, are just the little tiny stocks that nobody trades anyway, because a small move in a tiny stock is going to be a huge percent. And so they show you the percentages. It's almost worthless in my opinion. So these are not really that great. Okay. But this is a cool little tool right here. This one right here is called a heat map. And it tells you this is basically the S&P 500. Well, it shows you right there. S&P 500 is basically the stock market, okay? The 500 biggest, best stocks in the whole stock market. And so let's kind of move that so you can see it without me being in front of it. So this is the S&P 500, the 500 biggest, best stocks. Now you can see the Dow 30. We talked about that last night. And again, remember the reason they have the numbers next to them is because that's how many stocks are in it. So there's 500 stocks in the S&P 500. There's 30 stocks in the Dow 30, and there they are. That's what they are. And now these are the little ticker symbols that they use to identify them so they don't have to write out the whole name. And then this is the NASDAQ 100. So there's the 100 biggest, best stocks on the NASDAQ exchange. Here's the Russell 2000. Now there's 2,000 stocks. And the reason they make it a heat map is so you can kind of look at it and say, well, is the market overall up or is the market overall down today? If there's more red, we're having a bad day. If it's more green, we're having a good day, right? So this is all stocks. And of course, it puts it down into all the stocks that they're tracking. And then it puts it down into different categories. Okay, so you got different categories, and then you got world stocks. So you can go over and do foreign stocks. So you see Canada, Ireland, United Kingdom, China, Japan. We don't trade mostly of these. We don't trade these. All right. So we're going to just trade on the U.S. exchanges with our U.S. brokerage firms. So it's fun to look at, but you don't trade these for the most part. And then here's ETFs. These are the exchange traded funds. All right, we talked about those. So these are baskets of stocks, and you can see which ones are doing well. Oh, the ones that are green, they're really showing up good. Some ones that are red, they're not doing so well today. But these are the different ETFs, or the exchange traded funds, that you can come and choose from. And then here's crypto for those of you who like to do crypto. That big one, of course, is Bitcoin. We got Ethereum. We got some others. And of course, you can do baskets of these as well. There will be baskets of crypto. And then there's futures. This is the futures market. So you can come and look at corn and wheat and soybeans, Japanese yen, Canadian dollar, 5-year T-note, 2-year note, the Russell, the NASDAQ. The S&P 500 is also a futures contract. You can trade the S&P 500 in the stock market, or you can trade it over in the futures market, as well as the NASDAQ and the Russell. Those are some ones we like to trade a lot. Those are fun ones to trade over in the futures market when you're day trading. All right. So these are some others. Here's gold and silver, platinum, palladium, copper. These are some fun things to trade too. We like to trade those, but you need a different software program to trade the futures market than you use for the stock market. So once again, just real quick here.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here. Follow along, and I'll show you all my settings.
All right, you notice there's two versions. There's a stocks version, and there's a futures version. You don't want to mix your chocolate with your peanut butter. If you're going to trade futures, you get the futures version of the software, and we'll show you in future classes why you might want to do that. And if you're going to trade stocks, you get the stocks version of the software, and then we're going to show you why you use that one. All right, so there are two different software packages. One connects to Chicago, one connects to New York City. All right, so that's the difference. So we're going to come in here and we're going to look at the S&P 500, and here's Microsoft. So now Microsoft tells you the symbol is MSFT. So we can come over here to our trading platform, and right up in here in this little window in the top right-hand corner, it says type in the symbol of the stock you want to look at. So you type in MSFT just like that, and you hit enter, or you hit open symbol, and there's the price of Microsoft. And you look at that and you're like, wow, Microsoft's been doing really well lately. Yes, they have. Now we can draw all over this chart. This is like a drawing program. That's what's so cool about having a full live trading platform, is not only can you trade on it, you can also draw on it. So we can come in here with all these little tools across the top, and we can draw on there. So we can draw trend lines. We can come in here and we say, oh, look, the market went up almost just kind of like that. Now I'm going to make this a little bit thicker so you can see it a little better. There we go. And then we can come in here and say, oh, but then it went and turned and it went down like this. And then it went back up like that. And then it went back down like that. Now it goes back up like this. One thing you're going to discover about stocks is there's, for the most part, almost all the time, there's one up for every down. All right. There's one up for every down. So if you come back in time and look at the chart and you draw your little trend lines, just draw lines across it. There's one down. There's one up. There's one down. This down was a little bit bigger, but we went down here. We had a one up. We went down here. We had one up. We went down here. We had one up. We went down here. We went up. We had one up. And then we had a big up. So you can see there's one up for every down. And so that's why we color code them to be red and green. Green is up. Red is down. There's one up for every down. Sometimes you get a little jig and jog in here like this where you have a little green. So it went down and then it had a little red, like it was going to start, and then it went red again. A little green, and then it went red again. But you can see little spots like that in there. But nonetheless, you can see that for the most part, there's one up for every down. And that's how you trade. You say, well, I want to buy low, sell high. All right, well, wait for the market to go down, and then wait for it to go up, then wait for it to go down, wait for it to go up, wait for it to go down, wait for it to go up. Now, these little bars in here, each one represents one day. So I've got it set to a daily chart. You can see that up here in the left-hand corner of the chart. That means it's a daily chart. Okay. And so we're going to come in here and we're looking at the price of charts. And the way you make money is you buy right here, right? And then you sell it right here, and you make the money the difference between where you bought it and where you sold it. We can draw a little dollar calculator on there, and you can see that that was for 100 shares. That was $2,891. Each one of those was 1 day. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. So in a 10-day period of time, if you'd have bought right here and you'd have bought 100 shares, you'd have made $2,891 on that one little move right there. Now, you look over here and it says, well, how much land was 100 shares? Well, this little price scale over here on the right-hand side of the chart tells you how much a share costs. Now, in this case, the share, it tells you right there. You can see this was a little dollar calculator I drew on the screen. It says the share was $400. So if you bought 100 shares, you had to put in $40,000. So you put $40,000 in, and in 10 days, you made $2,891 on your $40,000 share. All right. Is that right? 100 times 404. 404, is that 40,000 or 4? We're going to go, look at me doing math. 404.33 times 100. Yeah, $40,000. I did it right. Okay, getting my zeros in the right spot. So $40,000 to make $2,891 in 10 days. That's pretty good investment, right? That's a 7.15% return in 10 days. You can't get that at Cache Valley Bank. All right. So that's how you trade. Now, you can make money when the market goes down too. So you can come in here and say, well, the market's going down. I think I'll put my $40,000 in there, and it'll go all the way down until you get out. And let's say you got out right here. Well, the difference between here and there would be $5,983. So you made $5,983 on your $40,000 investment, which was a 12% return in, and we can use a little bar calculator, and it'll tell you how many days. Just like that. In 29 days. So in about a month, you made $5,900 on your $40,000 on Microsoft going short. That's called shorting the market. All right. And you can do that. You can make money when markets go down. Now, most of us don't. Most of us try to make money on the market when it goes up in the stock market. But in the futures market, we go short just as easily as we go long. In the stock market, we're more likely just to want to go with the greens. All right. And that's okay. Don't worry about going short. It seems a little complicated. We'll talk about that more in class, the idea and the concept behind it. But that's how you make money, right? You buy low and sell high, and you can sell high first and buy back low later. They let you do that. So that's how you make money. And you can make money when a market goes down too, if you want to play both directions. And that's all there is to trading. You just buy low, sell high, and then you make money. Or if you buy low and it goes lower and you hang on, you lose money. That's how you lose money, because you can lose money more easily in these markets than you can make money. Why, lad? But why? If there's one up for every down, why do people lose money? Well, because they get in like this right here. They might get in on a little spot like right here. Let's see. Where's a little spot that you might lose money on? Right here. You might get in right here. All right. You might got in right there on those little green bars thinking, well, it came down. Now it's going to go back up, and it starts to go down, and you don't get out really fast. Right. And you wait for it to go all the way down here. And then you decide, well, right here's where I'm going to get out. So you get out here and you lose money. All right. So you put your money in and the market goes down and you lose money. So you get out low. So you bought high and you sold low. That's how you lose money. But if you buy low and sell high, that's how you make money. So just do that. Just do that. Buy low, sell high. It's easier. It sounds hard. It sounds easier than it is. All right. So we come along and we're looking at the chart now. And we're going to say, look right in here. Are you going to buy? You're going to put your $40,000 in right here? Okay, well, it's green and it's starting to go. You can put your $40,000 in as long as you sell when it goes up there and turns red, as long as it goes high enough that that's how you make money. Is it hard? It's not hard physically. I mean, it's really easy to get in. All you do is you come over here and you go like this and you say, well, okay, I want to put my 100 shares in. It's $52,000 on this market. It's trading at 522 right here. You can see that right here, $522 per share. That would be $52,000, and you can hit buy. And that's all there is to it. You're in the market. See how it's almost too easy to put your money into the market. So you just bought it. Now, if it goes up over the next 10 days, you can sell it when it goes red, and you can get out and take your money. And then you get to share some of it with the government because you just made money. All right, so that's how you make money. We're in Microsoft. So we're going to talk about the different types of orders and all this kind of stuff in class tomorrow night. So don't miss tomorrow night's class. And then we'll continue. The next lab will be after this one, right? Or after that class. So today is Wednesday. We had class last night on Tuesday. So we have our Wednesday lab, and then we'll have class on Thursday night, and we'll have a Friday morning lab. All right. So we're changing up the schedule. A lot of people have been doing the summer schedule. Summer schedule was we were doing Tuesday mornings, Thursday afternoons, and Wednesday what were we doing? Tuesday mornings, Wednesday afternoons, and Thursday mornings. Well, our schedule's changing. We're no longer on the summer schedule anymore. So we're now on the school schedule, and so we have our labs after the trading classes. This first class, we only have 2 classes in the week, so we're going to have 2 labs. So class was Tuesday night, labs Wednesday morning, class is Thursday night. We're going to have lab on Friday morning. All right, so let's change it up. And the next week, we just roll right into the next class. Okay, so this is the introductory class. The next one, we start talking about gains and yield. So we start combining the two and show you how you can make money even if the market doesn't go up. All right, so we go off the yield. And that's the next class. I'd really highly recommend you guys jump into that one too. If you're not in it, go ahead and sign up and get into the yield class, because that one's going to be a fun one. And then we're going to do the class after that is going to be high yield class. And I really recommend you do all 3 of these classes. So, and then we can go into the next ones too, because they get really important as well. Even though the topic shifts away from yield and growth, we just start going into growth, but it's very important class too. And we'll talk about those in the future. All right, so that would be the whole semester. And I would recommend you take the whole semester and just plan on taking them. And then we're going to just have the lab will be every day after the class. And then those classes have 3 classes, not just 2. So they are Monday, Wednesday, and Friday. So we will have classes on Monday, Wednesday, Friday. We'll have labs on Tuesday and Thursday. We're going to have to have labs more often, aren't we? I'll figure it out. Because Monday, Wednesday, Friday, you can't have a lab on Saturday because the market's closed. So we're going to have labs on Wednesday and Thursday. So we'll have every single day, I guess. That's how we're going to have to do it. Monday class, Tuesday lab, Wednesday class, Thursday lab, Friday class. All right. So that's how we're going to do it through this next, all the way going into December before we get to Christmas. Okay, so you can see already that we put our order in and we're up $50. We've already made $50. Take the money, Len, get out. Okay, exit. You hit exit chart, you're out. You just made $50. There you go. Now, you can go down to shorter term time frames. Each one of these price bars right here, these little green bars and little red bars, these are called open, high, low, close bars, all right? And we're going to talk about those in greater length in class tomorrow night, but they represent the open, the high, the low, and the close of the daily time frame, right? What did the market open at? How high did it go? How low did it go? And what did it close at? And it gives you these little bars. If it closed higher than it opened, then the bar's green. If it closed lower than it opened, then the bar's red. All right. And then those little topping tails and those little bottoming tails are how high it went and how low it went compared to the open and the close, which is the body of the text or body of the bar. Okay. So now we can come down to smaller time frames. We can just right click on this chart and we can say, I want to look at a 1 minute chart. So now each one of the bars, instead of representing a day, represent 1 minute. Okay. So this is what Microsoft looked like for the 1 minute. So I'm going to turn on a little filter that makes them kind of look funny, but it makes them look better. So I call it cheat codes. So we're going to turn on the cheat codes, and that's what the charts look like. All right. So when you use the cheat codes, this is without the cheat codes. All right. So this is what most traders are looking at on most charting applications. So if you come over here, and actually I think I have the cheat codes turned on here too. So if we come over here and we go to Microsoft, MSFT, yeah, see, I got the cheat codes turned on this one too. Most people don't use cheat codes. All right, they just use this. This is what most people look at when they're looking at Microsoft charts without the cheat codes. But I turn the cheat codes on. I like the cheat codes. So here they are. Here's the cheat code button. You have to put it up there in track and trade. It's not there on default. I like to drag. You can customize your bars like that. You hit right click and you say customize toolbar, and then you got lots of other things that you can put in there. Lots and lots of stuff that you can put in there. And then one of them is HA, that's called Fibonacci. I call them the cheat codes. And you can just move that over onto the bar. And then you hit close and it'll show up there for you. And you just turn it on, turn it off, turn it on, turn it off, turn it on, turn it off, just like that. All right. So those are your cheat codes. And they tell you red and green. Hold on a second, I'm losing my voice. All right. So then you come in here and you say, Land, do I have to buy $40,000 worth? No, you don't. You don't have to open up your account with 40,000. Now, if you're going to day trade, if you're going to go in and out in the same day, okay, you have to have at least 25,000. At least. You probably want to have 30,000 if you're going to day trade. In the futures market, in the version I showed you for the futures market, you don't have to have 25,000. All right. You can open that account with like 2,000. You can start a lot, and then you can do that day in intraday trading to get in and out the same day. So what we just did was called a day trade. We got in, and then it went up. We made $50, and we got right back out. Well, that's a day trade, and you can't do that unless you have at least $25,000 in your account. If you fall below $25,000, if you lose a penny and you're below 1,020, if you put 25,000 in, you make one loss and you're 1 penny below 25,000, you can't make day trades. If you do, they'll lock your account for 90 days. All right, so don't do that. Don't do day trading unless you have $25,000 in the market. You have to stay in overnight. And I'll show you some strategies. We'll get into strategies. That's a little bit beyond today's class, but we're going to come in and just look at the different markets. And I want to help you find charts to trade. Okay, so the charts I want you to start with are going to be the most popular stocks in the entire stock market. And it's called the Magnificent Seven. All right, it's going to be Apple, Amazon, Google, Meta, which is Facebook, Microsoft, NVIDIA, Tesla. All right, those are the big ones. So I'm going to close this one because that's not one of them. And we're got a 1 minute chart. So here's Apple. So this is what Apple looks like. And the symbol is AAPL. And the way you find those is you ask ChatGPT. You come in here. How many of you have Google or ChatGPT? You can Google it. We don't use Google so much anymore, right? Unless we know what we want. So then we come to Google. But you can come to Grok. Grok's the one I like. I use Grok more than anything. All right. That's Elon's artificial intelligence. So we got things now. We got tools now to help you make money that we've never had before. So much nicer, so much easier, so much more fun. So all you have to do is you got Grok. You just pull up Grok and you come in here and you say, what stocks should I trade? Yeah, that's kind of a hard one to say because there's 15,000 stocks. Grok's going to say, well, you could let's narrow this down a little bit. So let's come in here and say, what are the top 10 stocks in the stock market, in the, let's say, the U.S. stock market? There you go. That's, what are the top 10 stocks? And it'll come through, go out and do a little bit of research for you. Hopefully it'll come back. Yesterday we were having problems with Grok. He got locked up. So he's out searching. He's browsing the web. He's taking his time on this one. I should have done quick answer. This is not a hard thing to find out, Grok. He's doing some real deep searching out there to find out. I'm going to set him off to the side just for a second while he does that. Look at this. Now switching to a broader search for the top 10 largest U.S. companies. I didn't say top 10 largest. I said the top most popular. Or did I? What are the top stocks? Oh, okay. Several sources provide varying lists, but some data seems outdated, like Wikipedia. Yep, that's why we're going to get Grokopedia. All right. I'm looking forward to Grokopedia. Grok's going to make his own Wikipedia. Come on. You're taking your own sweet time. Grok, you can go faster than that. Interpreting the request. Largest companies in the U.S. caps. He's just taking his own sweet time here. Just pulled up details lists from 2 reliable sources, and they're lining up nicely on the rankings, matching the extracted market caps closely with early data like 4.47 trillion for the top spot and 3.90. He's doing his research. He's really going after it. Taiwan Semiconductors. He's really going to take his time and make this a good search for you. Searching Walmart, searching JP Morgan Chase, market caps. All right, Grok, you're taking too long. We're going to set Grok off for the side. He's a busy little body over there. I'm going to pull up Google. This is Google's AI. Oh, well, now just as I do that, Grok finished. Okay, there we go. Grok did us a nice job here. Okay, NVIDIA is the biggest one, and then Apple, Microsoft, Google, Amazon, Meta, Broadcom, Tesla, Berkshire Hathaway, and Walmart. All right, so you should recognize most of those companies, right? So the only one we don't have over here in our list is Walmart, Berkshire Hathaway, and Broadcom. All the rest of them are part of what we call the Magnificent Seven, which are the tech stocks, all right? So the reason Walmart's not in the tech stock in the Magnificent Seven is because it's not a tech stock. So this is Apple, Amazon, Google, Mags, but you get the idea. You can use your different tools to help you identify different kinds of stocks. You can go into your Google and search, or you can go into your artificial intelligence scanners and search, and you can find different stocks to trade. All right, things we've never been able to do before. We've had to go out and just do our own research to try and find stocks. Listen to your uncle who makes a stock recommendation, right? No longer are you going to go off of plain old stock recommendations, all right? If your uncle comes into you and says, hey, I got a great stock you should buy, you don't ever listen to that anymore. Now you do your own work. Now you come in and you pay attention to your own, and you pull up whatever, uncle's stock that he says to put up. And he says, hey, well, you should trade Walmart. All right, well, pull up WMT. Well, I don't know what the Walmart symbol is. Well, in Track and Trade, you can just come in here and type Walmart then, WALMART. You pull it up like that, and it's going to pull up this little thing and it say Walmart. Oh, there's a bunch of Walmarts in here. There's the one you want right there, Walmart Inc. So you click on that one, say okay, and it pulls up Walmart for you. So if you know the company name, you can just type it in too, and it'll pull it up. Now, this is Walmart. Now, Walmart's a good company, right? We all like to go down and buy things at Walmart. We try to avoid it the best we can and buy from local companies, right? But if we can't find it in a local company, we'll go to Walmart. All right, so we go down to Walmart, and this is the price of Walmart. And then you can make it smaller. You can look back. Look at how Walmart's grown over the last, how far back is that? That's back in December of 2023 is right here. So this is the price of Walmart stock. It started back here at $50. Now it's $106. So in that time from January 2023 to today, 2 years, it's doubled in value. It's gone from $50 up to $100. Wow, that's pretty cool. I could have doubled my money in 2 years. That's good money, right? So if you put $40,000 in there back here, you'd be up at $80,000 up here. Now, to take advantage of that, you'd have to sell it now to take your money out, right? And then you wouldn't have as many shares anymore. So that's one thing. You have to sell your shares to make it. If you buy the house, you have to sell the house to make the profit, to realize the profit. Otherwise, you just have a more expensive house, all right? Now, the name of the game is to accumulate as many shares as you can, all right? So not only in this market, this is the gain market, but also in the yield market. And we're going to break those two apart and talk to them about them in separate terms. But right now, we're only talking about gain, so set the yield aside. But the name of the game is to get as many shares as you can, because the more shares you have, the more likely chance you are to make money. So you want to do what we call compounding, all right? So you want to buy low, sell high, take your profits, wait for the market to go low, and then buy them back again, buy some more, and then you'll have more shares at a lower price, and then the market goes up again. So you take your profits, buy more shares, take your profits, buy more shares, take your profits, buy more shares. That's called compounding, all right? It's called compound growth. Compound growth is how you get rich because you got to compound, right? You got to get more shares. The more shares you have, the more money you can make, because all the gains are made on the number of shares you have. So the whole name of the game of trading in the stock market is to get as many shares as you can. And then you have those shares rise in price, and you sell them, take the money, wait for them. And you don't have to do the same one. So if you sell right here, right? Let's say you bought right here and you sold right here. Well, you take your shares, and now the market's going down. You don't have to wait for it to go down. You can come over and go to a different market and find one that's already down, right? So, oh, this one's already down. I think I'll buy here. Now, we talked about this last night. Buy low, sell high is the name of the game of trading. Again, remember, there's trading and there's investing. Investing means you're going to put your money in there and you're just going to let it ride for 10 years, 5 years, right? Trading means you're going to look for these opportunities to buy low and sell high. So that's how you make money. But then you're going to take your profits, go find a different market to put your money in that's already low that you can buy low. It's really hard to buy low, though. Really hard. Buy low, sell high. I've showed you that that's how you make money in the stock market, but it's really hard to do because nobody wants to buy right here. Nobody wants to buy right there. Why don't they want to buy? Because the market's going down. And I don't want to buy a market that's going down. I want to buy a market that's going up. And last time, Land said, buy when it goes green. So I did. And then the market turned, went to green just for a few minutes, and it went down again. And I lost money. All right. So it's harder than you think to buy low, sell high. So we need to kind of find stocks that are easier to read. If you're having a hard time knowing whether the market is going to go up or down, find a different stock. This one might be a little bit hard. Look at how many little choppy things it had in here. All right. Had lots of choppy stuff all through here. It was choppy. It wasn't nice and clean and smooth like down through here, right? This was nice, clean, and smooth right through there. That was easier to trade, easier to understand. So these get a little choppy. Okay, well, let's go look at a different market that's not as choppy. Well, this is Google. That last one was Amazon. Oh, we know Google. Oh, Google's a good company. Look like it. Does it look like you're going to buy right here? The market kind of broke, went down a little ways. Now it's kind of starting to go up. Do you want to buy right there? Does it look like a good time to buy Google? Do you think it's a good time? I don't want to buy Google there. It's really high. It's already gone way up. Yeah, but can it go higher? Yeah, it certainly can if it's doing well. Right? So we always want to talk about markets that are making money. Well, how do I know? How do I know if markets are making money? Well, that's where you do these little research tools. And I told you about this little research tool called FinViz. You can't trade on it. All you can do is just look at the prices, but it's a good little research tool. All right. So you can come down here. And if we come down, and this is Microsoft, we were looking at Google over there. So let's go look at Google, G-O-O-G, put in the little symbol. You pull it up. And this is the price of Google right here. You can see it's the same thing that we have over in our live trading platform. Now, again, you can't place orders over here. All you can do is look at the price. You can find things to trade. And then this tells you it's got a little reporting system down here. And this is really cool. So you come down here and you say, oh, well, this is how many sales it's making. And this is the most important thing right here. Most important thing. If the company's not making money, if this isn't going up every year, you don't want to invest in this company. Why not? Well, because it's not making money. And when you buy stock, you buy it into a company that you're anticipating is going to go up in value. So the sales are going up. All right. Now, it's not good when they do this. Now, lots of people will tell you that it is good. All right. It's good for your shares because if you own some and they start buying them back, this is shares outstanding. So if this little chart starts to go down, that's not so good. All right. But this is going up and this is going up. So yeah, the reason these are going up, see, this is called earnings per share. How much money are they making based on the number of shares they have? So they have 12,000 shares outstanding, and they made $349 billion last year. Well, that ratio is $8 per share. So you take this number, divide it by that number, and it gives you this number. Now, when they start buying their shares back, since you're good at math already, you know that if you take this number and divide it by that number, and this number is going smaller than this number, it's going to force this number up. You're going to get a bigger number over here because this number went down based on this number going up. So this becomes a false number because they're making this number smaller. This is how many shares they have available. So remember last night in class, we said, well, when a company goes public and they start selling their shares, they don't sell all of them. They only sell some of them. All right. So they got 100, let's say 100% of their shares. They only sell out 25%. They still hold 75%. Well, they can control how many shares they want to give or if they want to take some back. Google's been taking some back. And what does that do when they take it back? It forces the chart to go up, which is good for you, right? Because you have their stock, you want it to go up. So they say, well, we're sharing our profits with you. That's how they share their profits with you, is by forcing their chart up by buying their shares back. But what that also does is it forces the EPS to go up. And that's what a lot of people look at to determine whether they want to be in the stock or not. Oh, has it got good earnings per shares? All right. Have they got good making money against the shares? So it's a false premise because they're buying them back. So it makes this number go bigger. And then they do that to try and attract more buyers to come in and buy their stock. Dirty little buggers, right? Sneaky little buggers. All right. And so then this is the most important thing for us. We want to just make sure they're making money. All right. Are they making money? If they are, we probably want to invest in them. So now we're going to come in and let's look at another company. Let's come in and look at Meta. Let's go see, is Meta making money? Let's go to META. Meta is Facebook. Does Facebook make money? You can look at their chart and you can see the chart goes up and down, up and down, up and down. But do they make money? Oh, yeah, they make money. Look at that. Look at they're making money. And they're buying their shares back. So that's going to force the stock up. So if you're in the shares, that's good. It's going to make their stock go up because they're buying them back. And so they're going to force the stock up. But that also makes their earnings per share go up. So this is, again, that's a false number because they're buying them back. All right. So you have to take that into consideration. If they're buying their shares back, you don't like to see that unless you're already in the stock. But since they're making money, what happens is the companies are losing money, so they're not making money. These bars go down, and they're buying their shares back. That's dirty, underhanded tricks, all right? But this is good. Meta's making money hand over fist. They're making a lot of money. Look at that, 164,000. And that's 2024. You can come and say, well, what are they making in 2025? Look up here. It tells you right there. Right now, they're up at 178 billion. And then we still got 2 months left. We're still October's at 2.5 months left. And they're already 178 billion. And in 2024, they made 164 billion. So their next little bar is going to be way up. Meta's making all kinds of money. Look at them making money. So do you want to be in Meta? Heck yeah, buy that Meta up. They're making money. That stock over the long haul is going to go up because they keep making money more and more and more every year. They're buying their shares back, which is going to force the stock up. So that's good for you if you own the shares. It's bad if you don't. All right. What's the next one we want to look at? Let's come in and look at let's look at Meta. Oh, that we just met Meta, Microsoft, Nvidia. Let's look at Nvidia. Everybody knows Nvidia. You know Nvidia? Nvidia is actually the biggest of them all. See that when we look at Grok's list? Nvidia is at the top of the list. Who's Nvidia? I don't even know who Nvidia is. Who is NVDA? Grok, don't take forever to answer. Who is NVDA? Grok, go faster. How do I hit quick answer? Just give me a quick answer. NVIDIA is the stock ticker symbol NVIDIA for NVIDIA Corporation, a leading technology company based in the United States. NVIDIA is primarily known for designing graphics processing units, GPUs, for gaming, professional visualization, data centers, and artificial intelligence applications. So the computers that run AI are all made by NVIDIA. And AI is getting really popular right now. So all these big companies, Meta, Google, Microsoft, Elon Musk, they're all building AI systems, right? And so they have to buy the computers that make those AI systems from NVIDIA. And so that's why NVIDIA, their stock, is going through the roof like this. So if you look back in time, this is what NVIDIA's done over the last, look at that, since this is back in 2022. So the last 3 years, that's what NVIDIA's stock has done. Now, it goes up and down, just like all stocks do. They go up and down. If you can catch the lows and buy the highs, you make more money. But if you just buy and hold it for a long period of time, you're likely to make money because they're making money, right? So as long as they're making money, their stock will keep going up. And it's when they stop making money and their stock starts to go down. Now, stocks go down sometimes, even though the company's still making money. So there's other factors that drive stocks up and down, right? Geopolitical things, all kinds of stuff will make a stock go up and down. But that's the nature of the beast. But as long as the company's making money overall, the stock will go up. That's the idea. Okay, so that's NVIDIA. And we can come in here, zoom in a little bit closer again. And we can see just the last year of NVIDIA, or the last 3 months. That's what it looks like. And it's coming down right now. And you're like, well, if I want to buy low and sell high, this is good. I want to see NVIDIA come down. Because when it comes down and starts to make green bars and starts to go up, I'm going to put some money in. And if it goes down a little bit more, I'm going to not put all my money in. I'll wait and see, maybe some more, and then it might start go green up here again, and then I'll make money. So that's how it goes, right? So you buy as it comes down. We got these little indicators right here. This little blue one's pretty cool. All right, I'm going to turn it on. It's called the Bulls and Bears indicator, and it tells you when a market's neutral, bullish, and bearish. So the neutral zone is yellow. So it comes in here and says, well, the market's pretty neutral right here. It's not bullish or bearish. Bullish meaning, of course, that the market's going to go up. Bearish meaning, of course, the market's going to go down. So that is a neutral zone, another neutral zone, another neutral zone. So actually, NVIDIA is pretty neutral right now. And if it breaks out the bottom, those bars will turn red. If it breaks out the top, the bars will turn green. And so it'll be bullish, meaning the market's going to probably continue to rise. If it goes red, well, it's bearish. The market's going to probably continue to fall. So it'll go down. If it goes red, it'll come down here and be red, 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 red. And then it'll probably go yellow again. And then it'll go green. And then that'll be a good place to get in because now you've gone from neutral to green. And that gives you a little bit of time to see that the market's curling and starting to go up. So that's called the bulls and bears indicator. When you get this software, it comes with it. All right. And there you go. So this is all green. You can see back here, if we slide back a little bit, look at how it's got green back in here, little yellows, and see how the yellow comes in there and is neutral, then it goes green and then red. And that's kind of just a quick little indicator, one of the best little indicators that we've got to help us to know when a market's bullish, bearish, and neutral. It's called the bulls and bears indicator. It comes with Track and Trade, the software that you get right here. All right. And that's how you know. Pretty good idea. You can turn off some of these others. We got lots of tools in here. Turn off some of this stuff just to give us an idea of when markets are going to go up and down. All right. Red, yellow, and green. Pretty simple stuff. All right. So we're going to save that. Save settings to apply to all charts. So now we have all of this. And then we have this other one down here I like. This is called the chalk and money flow. This is called technical analysis. All right. Because we're doing math. Math is called technical analysis. And this little tool tells you, well, the markets are down in here. So that's probably a good place to buy the market. And then when it goes up in here, it says, well, the market's up. They probably wanted this where you want to take profits up in here. All right. So this has been profit taking all through here. And then this is the buying down in here. That's why it's green. So, oh, the market pulled down. That's what you want to get. You want to buy low, sell high. So this little indicator kind of helps you with its math doing that. So you can see as we went back in time, this is where you want to be green down in here and buy. This is where it's red up in here. This is where you want to sell. So this is buy. This is sell. This is buy. This is all sell. And went crazy up there. You sell out, make your money. Okay. So that's buy, sell. And these two tools work hand in hand. It's called the chalk and money flow. And these two tools work in hand. The bulls and bears telling you when the market's red, yellow, and green. And then the chalk and money flow tells you when the market's overbought and oversold. Okay. Accumulation, distribution. Remember, we talked about that in class last night. We mentioned it. This is your accumulation stage. This is your distribution stage. This is where you buy. This is where you sell. Okay. So that's the way you do it. And let's go look at another market. This is Tesla. We all know Tesla. Again, make that same comment made last night in class. Some people like to drive them. Some people like to scratch them. Whether you like to drive them or you like to scratch them, either way, you can make money off of them. All right. So here is the last run in Tesla. And you can see that their shares, Tesla shares, are $434 a share. That's a lot of money. Okay. So we can come over here and I'm going to set Grok to work. All right. So we're going to come into Grok again. We're going to say, Grok, give me the top 10. It's going to take a while to do this again. So we'll set him to work and we'll go off and do something else. Give me the top 10 stocks in the US stock market between, let's say, under $100. So we're not paying $400 for one share. We're paying $100 for one share. You could go smaller, but $100 is kind of the number people like to stay under. So under $100, but above, let's say above $50. So we don't want to get penny stocks, all right? That are the best stocks under $100, but above $50. So it's going to take him a minute to go find this one. Top 10 stocks in the U.S. stock market under $100, but above $50 per share. Okay, so let's tell Grok to go find those for us. And in the meantime, we're going to go look at some others. What are some other stocks that you guys can think of? What are some other big companies you know? What about Caterpillar? You guys know Caterpillar? I'll bet you can guess what the symbol is for Caterpillar. You were right. It's CAT, C-A-T. So we're going to go look at Caterpillar. Oh my goodness. Oh my goodness. Look at this chart. Caterpillar. What if you'd have bought Caterpillar? Now, Caterpillar shares were $300 a share to buy one share right here at that level. All right. So it went up. And let's say we just held it till we got the first out arrow right there. So we're going to draw a dollar calculator from here to here. That was with 100 shares, which that would have been $30,000 because it was $300. Now you can do your others, and maybe you can afford one share. Okay, that's okay. It's all based on percentages. It would have been a 31% return on your money over that period of time. How long was that? That was 1, 2, 3, 3.5 months. So in 3.5 months, when we got the little signal from the bulls and bears, which comes in here breaking out of the yellow bar, and the crossover right here, the green to red, then you buy right there. If you bought right there and rode it all the way up until we got this little crossover right here, see that, how they correspond together, then you end up like that. That would have been a 31% return in 1, 2, 3.5 months. On this, we did 100 shares, so it was $30,000. You would have made $9,857. That's pretty good money. All right. Well, I want to do it again, Lan. Okay, well, look at this. Right here and right here. Let's get in right there. Okay, we're going to get in right there. And we're going to go from this little spot to this little spot. Where's it at right now? It's right there. So that over the last 2 months, not even full 2 months, about a month and a half, that was a 22% return on your money. And again, on 100 shares, that would have been $9,456. $9,456 on 100 shares on a $30,000 investment. But Lan, I only have $50. Okay, that's okay. Nothing wrong with that. It still would have been a 22% return. That's better than you can get at Cache Valley Bank. But Lan, what if I'd have put my $100 in there and it went down instead? Well, I'll tell you one rule. If it doesn't immediately go in your favor, just get out. Wow. If you're not making money, get out. Oh, I didn't think of that. Yeah, you could just get right back out again. That's what I do. I don't hang on to a stock and let it go clear down here if I'm not making money, right? We don't. Why would you do that? Well, because I think it'll come down and it'll turn and go back up. Just get out. If it doesn't immediately go in your favor once you get in, why would you want to be in that stock? Just get out. You can go buy another stock. There are lots of little red signals like this. There's a lot of them. You can find them everywhere. All right. There's lots of little signals like this where you get a little crossover here, a little crossover here. You can take it. And if it doesn't immediately go, like right here, if you do this one and it goes up and then it just doesn't, oh, it went yellow again. All right, get out. Didn't work. You want to wait and stay in there as long as it's green. All right. As long as it's green, you can stay in. As soon as it goes yellow, get out. Yeah, you might want to get out on yellow because yellow sometimes it'll go a little bit yellow sideways through here. It's when it goes red. Then you get out. All right. But kind of watch this too, because that'll kind of help you know. But you're just going to have to do you. All right. But the name of the game is just as long as it's green, stay in there. When it goes yellow or red, when it goes red, get out. But if you get right in, if you get in and it immediately goes yellow or immediately goes red, you know, if you get in, it goes green and then goes yellow again, you can kind of stay in and just don't let it take any money away from you. As soon as it starts taking money away from you, just get out. It's the hardest thing for me to teach people to do. If you're losing money, get out. But don't let it lose a whole bunch of money. All right? Don't say, well, I'm just going to stay in it and hold on to it forever until it goes back up again. No. If it's not going up, don't get in, all right? And if it goes up a little bit and then starts to go back down, get out. It's such a hard concept to get across to people. If you're losing money, get out. All right? But once you're making money, you don't have to get out every time it starts losing money because you can wait for it to turn the color, right? It's only when you first get in. If it doesn't immediately start going in your favor and making you money, get out. Okay. Once it starts going up here, you can be a little bit more careful with it. You can be a little bit more, all right, I'll stay in if it goes back against me a little bit. But as soon as those colors change color, get out. Unless you're going to, that's a trader. Now, if you're going to be an investor, that's a different story. You're going to stay in for 5 years. All right. Okay, we can sit through some drawdowns. We can sit through some of this. We can dollar cost average in, buy a little bit more as it comes down. That's investing. That's different. This is trading. Trading versus investing. If you're going to invest, you can roll through some ups and downs, and that's okay, because over the 5-year period, we're going to anticipate that market's going to be much higher in 5 years from now. But don't think you're going to be a trader and turn into an investor. Oh, I'm going to put some money into Caterpillar. I'm going to be a trader. I'm going to try and make some money this next month or this quarter. It's going to go up, 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 up. And then it starts to go down. Oh, down, down, down. I'm losing money. Oh, I'm going to lose more money. Oh, I'm losing more money. Oh, now I'm an investor. Suddenly I decide I don't want to be a trader anymore. Now I want to be an investor. And I'm just going to hang on to it for the next 5 years. No, you're not. That's what we call a bag holder. All right. You got in anticipation of buying into a rising market, and then it went against you. And rather than get out when it got back down to just a small loss, your first loss is your best loss. All right. First time you start to lose money, that's the time to get out, because it can keep going down, 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 down. And if it does, you lose a lot of money. Then you're like, oh, I'll just hang on to it until it comes back. It may never come back. It might not come back for 5 years. Okay. Well, I'm going to suddenly turn my trade into an investment. No, that's not how you do it. If you're going to be a trader, be a trader. If you're going to be an investor, be an investor. If you're going to be an investor, you probably want to be investing in ETFs, exchange traded funds, things you're going to put your money in that's got like 10 stocks in it, and it's a basket of stocks, and it's diversified for you already. You're going to put your money in there, and then that one, you're just going to close your eyes and not look at it for 5 years. All right. That's a diversified portfolio for investing. If you're going to do an individual stock, you're going to probably be a trader. Not that you can't be an investor in an individual stock, you certainly can, but mostly you're going to be a trader. You're going to buy low, sell high. You're going to make money. All right. That's the name of the game. So if you start losing money, just get out. I have to ask people that, I'm down 30%, I'm down 50%, I'm down $10,000 land. Why didn't you get out when you were down $50? Because I didn't want to lose my $50. I wanted to get it back. But now you're down $10,000. I know. But now I'm an investor. I'm just going to hold on to it for 5 years. Okay, do that. I'm not telling you what to do. I'm just telling you what I do. All right. Okay, Grok's done. He said, okay, here's some really good companies that are below 100 and above 50. All right, look at that. Grok's done some hard work for us. We're going to come over, and I'm going to take all these. I'm going to look at this. I'm going to show you something else that's really cool. You don't have to go type all these symbols in. You can tell Grok to do it for you. Hey, Grok. Hey, Grok. You don't have to say, hey, Grok. He knows he's Grok. Hey, Grok, can you, let's see, put the symbols into a comma separated format? See if you can do it. Understanding the request. The request has to format the symbols into a comma separated list. I've got Grok on slow mode. Okay, there they are. Look at that. He put all the, look, here's all the symbols right here. I told him to put them in a comma separated list. So now all I have to do is copy them, just like that. Hit Control C, copy, right? Or you can right click on them and say copy, either way. Now, when we come over to track and trade, take that back off the screen over here. Now we come over to track and trade. We can start a new portfolio. We'll come in here and we'll say under 100s, under 100. And what was it? Above 50? We'll just put that in there. Above 50. Okay. So that's our new portfolio name. It's empty. We're going to put our little cursor right up there and hit Control V, right? Or you can right click and say paste, and it's going to paste your symbols in there, right? Just like that. And then say open symbols. Boom, 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 boom. That's an easy way to do it, right? Less typing, faster. Faster's better. All right. Wait for it to retrieve all the data. Let's retrieve the data for this one. Look at that. This is one of the top stocks, according to Grok, below 100, but above 50. So this is called AstraZeneca. Some of you might be shooting some of that into your arms. Something from AstraZeneca. All right. They make shots. So what do we want to do? Well, we want to buy low, sell high. Right here. Oh, right there. That's a good spot. What about this one here? It went kind of funny. Well, we were already into it, so we didn't get out. Now, look, there's these little blue dots right here. See little blue dots? We usually want to get out or in around where these little blue dots cross. So if those little blue dots correspond with the crossover of this here and the color coding of the yellow and green, those are places to get in or out of markets. So if you come down here, here's another one. So this one is saying that we want to go from that. This is where we want to get out of a market right here. And you get the arrow that says get out right there. But where do we want to get in? We want to get in right in here, right in here. We want to get in. Now the crossover, the little blue lights were here. So you want to get in right in here. All right. So this kind of came back against us, but you can see like right in here. Here's a good little spot right in here. This is going to get you in, little arrow. Problem is if you get that arrow, little crossover, you want to try and get in as early as you can. If you wait, that's a big long bar. It took off like a rocket ship and you got in late. You might be in way up here and then you're not going to make any money. You left it all on the table. But then you can see where the little blue lights come in. So the little blue lights cross, like right here. That's generally a pretty good area if it corresponds. It didn't correspond very well, so you kind of want to go, I'm not sure if I want to do that. All right, so that's kind of how you read this one. Where do you want to get in? Where do you want to get out? All right, so the little blue lights are very helpful. Let's make those little blue lights easier to see. We're going to make them bigger. There we go. Oh, we can make them even bigger. That's a little too big. There we go. All right. So that's kind of the way that one is. Let's go ahead and look at the next one. This is BAC. This is Bank of America. Bank of America. Look at this. We got a little indicator here, changing from red to yellow. We got kind of a little fall right in here. Kind of market went sideways. We got kind of a little sideways thing happening. And then the market went in here and then here. This is all green, so we could buy down in here. Then the market kind of did a little green right there, just a kind of a little dip back down in right in here, huh? And then you could buy in there, ride that green up. So these are just locations that you can buy into these markets, all right? It's not rising like super fast, but that's pretty good market. That climbed pretty good, right? So if you're down here and you're like, well, this market's really beaten up bad, but if we come over here, we go to this one and we pull up that symbol, AstraZeneca, oh, that was Bank of America we were looking at. We're going to come in here and we're going to pull in BAC and go see if they're making money. All right. BAC. Now we're going to come down here. Are they making money? Oh, they making money. They're making money. Let's see. 195 last year. Let's see what they're making this year. Sales 195. Oh, look at that. So they're at the exact same sales price they were last year, and we still got 2.5 months left to go. So they're reporting $195,000 in sales right now, and they're at 195 last year. So we still got 2 months to go. So we're pretty confident they're going to make more money than they did last year. So that's going to go up. So they're making money. Now their earnings per share are going down just a little bit. What are earnings per share right now? PE ratio 13.91. That's not the one we're looking for. We're looking for this is the trailing 12 months right there. EPS TTM says trailing 12 months. That's what this is reporting, the last 12 months. This is 2024. So we're 3.67 and this is 3.21. Well, that's good. It's got a higher earnings per share than what they had last year. But they're also buying back their shares, which is propping up their earnings per share, right? They're making more money. They're buying back their shares, propping up their stock, giving them a higher earnings per share. So you can't look at earnings per share and think that that's going to be, they're making earnings per share or doing really well. Well, look, they're buying back their shares. That's why the earnings per share are doing well. More interesting is how much money are they making? Are they making money? They are. They're making money. Okay. Well, then we might want to be in this stock. It was BAC, Bank of America. Now, you can't buy the stock through this little program. So you come back over to your trading program and you say, I want to buy me some Bank of America. Oh, I want to time it. Oh, this isn't very good timing right here. It looks like to me it's trying to come back down again. I'll wait before my Bank of America. But if I did want to buy Bank of America, I just come over here, put in however many I want. I want one share of $50 and I hit buy market. And didn't I hit the buy button? I did. Why is it being slow? Could not place my back order. I wonder how come. Anyway, that's how you do it. You hit buy market. This is a demo account. So maybe in the real account, it would work just fine, probably. All right. So that's Bank of America. But it says it's making money, but right now is not the best time to be buying Bank of America because it looks like it wants to come down. Now, this is yellow, so it's neutral. This is where it said to buy right here. right here. We're going from a little green to red, so we're just going to wait for this to turn red. It's coming down yellow right now. As long as it's yellow, we want to see a green bar. As soon as we get a green bar, boom, we can hit that buy market button, put some orders in there. All right. Let's go look at the next one. This is Cisco. Cisco Systems. Cisco. Ooh, boy, it's just done nothing for the last 4, 5, 6 months. Just gone straight sideways. I wonder what's wrong with Cisco. How come they're not going up? We can go over and take a look and see, are they making money? Come in here, type in CSSCO. And we come down here and, well, they're kind of not really making big growth spurts, are they? Kind of consistent. Sales at 56 billion. And 2025, oh, look, they got 2025 in here, 56.65. That's cool. That's just new. They didn't used to put that down here. Why wasn't it down there for BAC? BAC. See, it stops at 24, and we had to come up here and look and see how much money they were making. Income 25, 24. But on Cisco, now I wonder why. That's the first time I've ever seen that. They actually put it down in the window for 2025, even though 2025 is not over. So we got our 58,000 down here. That's really cool. And this 56,000 up here. So you can see they're actually reported that. Maybe it's because they're reported. I don't know. It's the first time I've ever seen them put 2025 down here in the list. Maybe that's a new feature. But they're buying their shares back. It's not good. We don't like that unless we're in it. So they're buying their shares back. Their sales are greater than last year, which is, and their earnings per share is down. They're trying to push that higher. This is 2025. They've got that in there. That's awesome. Okay. You can see that a couple of companies in here, HSBC downgraded. We're going to see those guys go down to $69. This company says they're anticipating going to 72. Well, what are they at now? They're at 70 right now. Well, a downgrade and they expect it to go up. That's kind of funny. And then 69 is where they expect to go down with a downgrade. So they're expecting the market to come down in here somewhere. Not that that's a big stretch. It's just popping around back and forth between those numbers. And they're, I think it's going to go to 69. Well, you're brave, really brave there to put out there a price target of $69 when it was trading at 70. I think it'll go down $1. Oh, you're probably going to be right. These banks, these guys, they don't know what they're doing. Don't listen to those guys. I don't know. You have to listen to them because a lot of other people listen to them. This is a Me Too market. It's a Me Too market. So they're like, well, me too. The market's going up. I want to be in that. So, this is definitely a Me Too market. You want to follow the crowd because the crowd is what moves the market up and down. HSBC. There's that one. Looks easy at the time, doesn't it? Looks really easy. What are you going to do with that one? Here's Coca-Cola. Holy cow, look at Coca-Cola. That thing's going to the moon. $71 a share. Wow, look at that thing go. There's Merck. There's NVO. There's Shell Company. There's Uber. There's WFC. Wells Fargo. All right, guys, that's the end of class today. We've blown through our time like we're sitting still. Man alive, time goes fast when you're having fun. So that's just an introduction for our lab class so that we can get started. You guys who are just getting into the markets can go in and start playing with your tools, start looking at your charts, start finding stocks to look at, and you got your tools in here that you can just start looking to see, well, where would I have bought? Where could I have bought? And start learning. That's the whole idea. The more times you look at charts, the more charts you look at, the more indicators you kind of line up with those indicators. Don't look at 10 million indicators. That's not going to help you. Just pick the best ones, and I'm telling you which ones I like, so you can use the ones I like if you want to use the ones I like. And then just kind of make your decisions, and you can buy in, and you can do a little dollar cost averaging if you want to. But you can also, if the market doesn't immediately go in your favor, just get out. Start small, put in $10. You don't have to put in $40,000. You don't have to do that. You start real small, all right? You just can't take it out if your account balance is below 25,000. Now, you don't have to have $25,000 in one market to take it out in the same day. You just have to have an account balance of 25,000 to day trade, to get in and out the same day, all right? So just don't do that, and then you'll be okay. All right, so that's the name of the game, and that's how we do it. And we're going to pick up from here Tomorrow night, we will see you in class again, bright and early. Don't you dare drop out on me. All right. I don't want anybody dropping out. No dropouts. All right. We're just getting started. So no dropouts. Okay, guys, we'll see you tomorrow night. If you have any questions, please let me know. You've got my calendar. You've got my office hours. You've got my email address. You know how to get a hold of me. So let's do that. And I'm going to leave you with one more thing. Because I really want you to pick up Pitt News Magazine so we can communicate with each other after classes are over.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, so that's it. We're going to let you go, and we will catch you again tomorrow night in class down at the university. Okay. Take care. Have a good day.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.